Today we're going to have a look at basically hedging, transaction and currency exposure. And we're going to be trying to look at how companies might approach their risk exposure and what they might do about it. And a key part of this is to focus on money market hedges, which are basically a way for companies to try to deal with some of their risk through the use of debt instruments. So that's basically what we're going to be focusing on. All right, so there are three different types of risks that companies might face. We've got translation exposure, transaction exposure, and operating exposure. So those are the three main things that companies might have to deal with. Now, in terms of the ones that are economic exposure, we've really got two. We've got transaction exposure and we've got operating exposure. Now, transaction exposure is going to relate to things that are obviously due to transactions that might arise, and in particular that have arisen in the past. Operating exposure is due to things that are going to be ongoing. Translation exposure primarily relates to those things that are translating balance sheets or translating financial statements. So, for example, they might arise where you're perhaps translating a financial statement to an asset or a liability, or whatever the case might be, between two different currencies, which is where that translation exposure ultimately ends up arising. So translation exposure is basically an accounting or a balance sheet type exposure. So it's the type of thing that is going to arise in more of an accounting context than in other types of actually operating contexts. Basically, it's going to arise where you have to convert financial statements from a foreign subsidiary into perhaps your home country's currency. It's going to affect investors because it's going to affect what the company is worth on paper, but it's not going to be impacting the actual amount of money the company needs to pay. Rather, it arises where you're translating between two different currencies. So it arises due to reporting and consolidating between different countries and between different companies in those countries. So for example, say we have a London-based company and needs to consolidate the financials of a US-based subsidiary and a Japanese-based subsidiary. In either case, you're going to need to convert the money from these into pounds, which is going to create translation exposure. Companies need to consider this, but in broad terms, you wouldn't go about hedging it, i.e. you're not going to generally incur additional expenses purely for the purpose of dealing with translation exposure. So in terms of managing these translation exposures, it's an accounting exposure or a balance sheet exposure. One would need to convert these balance sheet financial statements between different currencies, i.e. from the foreign subsidiary's currency into the home country's currency. Now, in general terms, one wouldn't go about actively hedging this because it's not particularly an economic exposure. One could try to perhaps manage it through exposure netting. So, for example, you might try to manage it by having different currency exposures in different directions, i.e. an asset in, say, yen and a liability in yen to try to ensure the two offset one another. But in broad terms, one wouldn't go about getting an option or going about futures contracts because that could ultimately entail a lot of other costs. Now, one could potentially use forward contracts to manage it, but it's often going to be quite costly to do so. The reason it would be quite costly is whereas with this translation exposure, you don't necessarily have an economic exposure where you're actually paying in that foreign currency. Rather, it's an accounting issue. Now, you could use a forward contract to offset that. However, forward contracts do convey actual cash flow costs. So it's something that one needs to consider, but it's also something that can be incredibly costly if you go about trying to hedge in that manner. Now, economic exposures are the main types of ones where you're going to want to hedge them. An economic exposure basically arises where there's some form of cash flow implication. It could arise either because you've already entered into a contract and there are future obligations that are going to come up, or future receipts that are going to come up, or could arise because during the course of operations, you're going to perhaps receive revenue in a foreign currency just by selling goods if and when that occurs, or something along those lines. So in either case, it's something that's going to have some clear cash flow or economic implication. Now, the exact amount of this exposure is going to depend on the present value of those expected cash flows. So that firm value aspect is or that impact on firm value is really the impact of this type of economic exposure. Now, we're focusing here on the impact on firm value, and we're focusing in particular on the idea that the value of a firm is simply equal to the present value of all future cash flows that firm is expected to generate. And hence why if our cash flows change, then the value of the corporation might change, which is why hedging can sometimes be important in this context. Now, importantly, economic exposure has two components. operating exposure and transaction exposure. Now we'll see what those two different concepts entail in a second. Now hedging in this context is going to involve reducing the volatility and risk associated with those exposures, i.e. reducing the volatility in earnings. Now hedging should be considered as a cost. It's a cost because it's often expensive. For example, with an option, you have to go out and you have to pay a premium to purchase that option. So it can be costly to engage in hedging. It can be considered as being like buying financial insurance here, i.e. you're buying insurance against the currency moving in the direction that is not what is going to be helpful to you. Now, to some extent, this can be done through exposure netting, but exposure netting is often not going to be a complete solution, because oftentimes you won't be able to net all of your currency exposures. So you might need to hedge through other financial instruments or other methods. Now, often this can be centralized at the parent company level. It can be centralized because then you avoid duplication of contracts, and you can ensure that you're only going to hedge the net exposure that you ultimately are facing, as opposed to hedging multiple different exposures which might have otherwise netted out. Okay, so if we focus on the two different types of economic exposure, we've got transaction exposure and we've got operating exposure. Now, transaction exposure refers to things that are risks rather that relate to known exposures, so known contractually binding cash flows that might arise. So these can, for example, at a very obvious level, relate to known debt payments that you've already locked in, which could potentially have foreign currency implications if those debt contracts or obligations are denominated in a currency other than what your cash flow receipts are going to be in. So importantly, the transaction exposure relates to known contracts. Operating exposure relates to future operating cash flows. So cash flows that might arise in the future by virtue of things such as sales that could arise or those types of exposures. Now it is prospective in nature, i.e. it's forward-looking. Contrast that with the transaction exposure, which is retrospective and prospective. It's retrospective in that it's going to refer to already entered into contracts, but is prospective in that it refers to cash flows that are occurring in the future. Operating exposure is purely prospective, however, i.e. it purely relates to cash flows that are arising in the future, and is based on estimated future cash flows. It is also relevant for some domestic firms. It can be relevant for domestic firms with purely domestic cash flows. The reason for this is foreign exchange changes can influence how much you ultimately end up selling. Now, the extent to which you would actually hedge any of those types of things, if you're a purely domestic firm, is obviously going to be a case-by-case issue. The more clear-cut one is where you're a multinational firm with foreign currency exposures. So in that case, you're still going to have this transaction exposure. In a purely domestic firm, you can still have some exposure because of the impact on demand and potentially the impact on supplies and the supply costs that might arise. i.e., as foreign currencies change in value, you might change your supply costs. So it can have an on-flow effect to these domestic firms. Okay, so let's think about hedging. Now in hedging, there's a few different concepts that arise. So when we're looking at currency risk, we've got concepts like forwards and futures. Now a forward or a futures contract locks in an exchange rate. So effectively it's an obligation to buy one currency and sell the other currency at a predetermined exchange rate at a predetermined date. Now the futures contract is exchange traded, whereas the forward contract is over the counter. So the forward contract is more likely to perfectly match your exchange exposure, whereas the futures contract is more standardized, but by virtue of being standardized, there's basically no counterparty risk. You've also got foreign currency options. Now foreign currency options give you the option, i.e. the right, but not the obligation to buy or sell the predetermined currency at that predetermined date if it's a European option, at the predetermined exchange rate. If it's an American option, you could exercise it at any point up until the expiration date. So the options here rather, they convey a premium, i.e. you have to pay a premium if you've bought an option or you receive a premium if you sell an option. So there are costs involved in buying these options. You also have various other different types of transactions or types of operations that you can use to hedge. So you've got currency collars. Those, for example, could arise through the use of options, i.e. option strategies. You've got cross-hedging. which can involve multiple different things such as hedging in different currencies at different time periods. We've got currency swaps. Now, currency swaps could, for example, entail you swapping the denomination of the currency in which you're borrowing with that of a counterparty, amongst other things. Or they could involve swapping whether it's fixed or floating rate interest with that of a counterparty. So you've got currency swaps, which enable you to perhaps change the currency of your obligations and therefore maybe enable you to more effectively net your currency exposure. You have risk shifting, which is effectively going to entail you forcing your counterparty to bear the currency risk, i.e. you force that counterparty to denominate the contract in your currency. Now, obviously, someone is still going to bear a currency risk, but in that case, it's just the counterparty. You've got exposure netting, which is a situation where you try to net your obligations with your receipts, which ensures that you've got your inflows and your outflows matched up in the same currency. And you've got some form of currency risk sharing, where you're effectively sharing the currency risk with your counterparty. Now, in terms of interest rate risks, you have the interest rate swaps. So those swaps involve, for example, swapping whether it's fixed or floating rate debt with that of a counterparty. So you're able to get better access to the type of debt that you prefer to hold. And you've got forwards and futures. These could involve things like forward agreements or forward rate agreements, which enable you to lock in an interest rate that is going to operate over your future borrowing. So those types of instruments can be used for hedging in this broad context. We've also got money market hedges. Now, money market hedges are an important strategy here. A money market hedge is important because it effectively enables you to lock in an exchange rate, and it does this through the use of debt markets. So what you need for a money market hedge to work is you need access to debt, because you're effectively going to be borrowing in currencies here to try to lock in an exchange rate. And this is going to lock in implicitly an exchange rate to apply to some future receipt or some future obligation. And we'll see how that works through the use of foreign borrowing or foreign lending. All right, so it enables you to borrow or lend in these different currencies. So you'd be borrowing in one currency and lending in the other. So you borrow and lend at the same time in two different currencies. Notably here, two different currencies because we're hedging. This enables you to lock in the dollar or at least currency value of your foreign exchange or foreign cash flows. So you implicitly are hedging your exposure here. So let's have a really basic example here. In 1 year's time, you're going to receive 10 million euros. You want to fix the US dollar value of your euro receipt. So notably here, you're going to get euros and you want to convert it back into US dollars. So you want to fix this USD euro exchange rate, i.e. fix how many US dollars you get per euro. So what you could, for example, do is you borrow the present value of 10 million euros for 1 year. Now you'll see why we do this, because say you borrowed the present value of $10 million in 1 year, you're going to need to repay 10 million euros in a year's time. But you're going to receive 10 million euros in a year's time, so that works out. So you convert that borrowing into US dollars at the current spot rate. So you've borrowed 10 million euros, you then convert it into dollars. You then invest your dollars. And now you invest however many dollars that happens to be. So it's going to be 10 million euros multiplied by your exchange rate, where your exchange rate is expressed as US per euro. Then at the very end, you're going to receive a certain number of US dollars. So you're going to get a certain number of US dollars. Now this is then going to tell you, well, you've got a certain number of US dollars, and therefore you've got this exchange rate being the number of US dollars you get divided by the 10 million euros that you would otherwise have received. So let's have a look at how this works when we're going through this. Okay, so let's have a look at an example here and look at how this might function. All right, so suppose we've got a euro interest rate of 7%. That's the interest rate that's going to apply, in our case, to borrowing and lending in euros. Now that's obviously a simplification, because the interest rate you get on lending is typically going to be different from the interest rate you get on borrowing. But nevertheless, we're going to assume that they're the same just for simplicity. The US dollar interest rate is 5.5%. The current spot rate is $1.5 per euro, i.e. you get $1.5 per euro. Convert 1 euro into dollars and you'll end up with $1.5 to be clear here. Alright, so what do we do? Well, we're going to be receiving 10 million euros in 1 year's time. So let's borrow that present value of 10 million euros, because we're going to be able to repay our borrowing with the euros we're going to receive in a year. So we're going to borrow 10 million euros divided by 1.07. We divide by 1.07 because we're getting the present value of 10 million euros, and the interest rate in euros was 7%. Hence, we divide by 1.07, and we end up with 9.35 million euros. Then what we do is we convert those euros into dollars, and we convert it at the spot rate. So here our spot rate is $1.5 per euro. So what does that mean? Well, to get our number of dollars, it's going to be 1.5 multiplied by 9.35. So that's going to be 14.02 million US dollars. Okay, so what do we do then? Well, we take our 14.02 million US dollars and we invest it for a year at the US interest rate. So we invest it, in this case, at 5.5%. So we've got our 14.02 million multiplied by 1.055, which is going to give us the value of that, the future value of that in a year's time, which will be 14.79 million. Then because we've received 10 million euros from our receivable, we're going to pay back our loan. So we're going to use our receivable to pay back the loan that we made in euros. So we're going to repay our loan using the 10 million euro receivable. So what we've done is we've locked in the US dollar receipt we're going to get. And we've effectively locked in this case, an exchange rate of about 1.479. So that's effectively how we're going to do it. Now at the bottom here, you can see the profitability or otherwise of this money market hedge. Now what you'll notice here is regardless of what the spot rate is at time t plus 1, i.e. regardless of whether the spot rate increases or decreases, we end up with the same total cash flow, i.e. we always end up with $14.79 million because we always locked in the amount of US dollars we were going to get. Now, in some cases that's good for us, in some cases that's bad for us. And let's have a look at why that's the case. Now, the reason we see this is say the currency ultimately would have been more favorable to us, i.e. say the currency were going to go up to 1.5 as our spot rate, or stay at 1.5 as our spot rate. Then in this case, we've got a loss. The reason for that is we would have been better off just converting our euros in a year's time at the prevailing spot rate at time t plus 1. Put differently, say the spot rate at time t plus 1 is $1.5 per euro. Then when we get our 10 million euro receivable, we would have gotten 15 million US dollars. So therefore our loss on doing the money market hedge is 15 million minus 14.79 equals a 0.21 million euro loss, a dollar loss rather. Now say the spot rate goes to 1.479, then in that case we break even because you can see the implicit spot rate on our money market hedge is 14.79 divided by 10 equals 1.479, so we've broken even because the implicit exchange rate on our money market hedge is 1.479. Say the spot rate at time t plus 1 were to have declined to 1.4, so $1.4 per euro, in which case our money market hedge has helped us because we would have locked in an exchange rate of 1.479, but in reality it went down to 1.4. So let's see what our profit would be. If we hadn't hedged, our 10 million euros would have been worth 14 million US dollars. So therefore our profit on the money market hedge is 14.79 minus 14 million if we hadn't hedged, meaning our profit is then 0.79 million US dollars. Now what you'll see in this final column of our table here is our total cash flow is always 14.79 million when we do the money market hedge, because we have implicitly locked in our exchange rate. In that respect, it has some parallels to forwards and futures. Now, it's obviously not the same as a forward or a futures contract, but you can think of it as having that same type of ultimate impact, i.e. you lock in an exchange rate. And it's also going to entail obligations because you can benefit or lose from the money market hedge. So it's not always going to be a beneficial operation, as you could see in our first example, where the spot rate ends up remaining at $1.5 per euro. So that's effectively how these money market hedges are operating. Now, this has some parallels as well to covered interest rate parity. However, it's obviously not the same because covered interest rate parity involves a situation where we're looking at futures contracts. So in futures contracts, we have locked in an exchange rate. So if we have a look at one basic example of covered interest rate parity, say you have the interest rate in the US of 3%, in Australia of 5%, a prevailing spot rate right now of 68 US cents per Australian dollar, and say our forward rate is 66.7 US cents per Australian dollar. Under covered interest rate parity, we would be going through a process of borrowing and lending in either currency, and also using a forward contract or a futures contract, as the case might be. It would have the same general implication as to whether we'd used a forward or a futures. Here we're referring to forward rates, of course. So what you would do in this covered interest rate parity example is you'd say borrow $1 and then you would have to repay that with interest at the very end. So say you borrow $1, you'd have to repay 1.05 Australian dollars in a year's time. Now you'd sell your $1 to get US, and you do that at the prevailing spot rate. So in this case, you'd end up with 68 US cents. You could then invest your 68 US cents at the interest rate in the United States. So here that's 3%, so you'd end up with 68, i.e. 0.68, multiplied by 1.03. And you'd end up with investing this, and you'd receive 70.04 US cents. Now, you would have used your forward contract, and say you used your forward contract, you'd be selling forward 70.04 US cents, and then you'd use that to convert into Australian. So you'd sell forward your 70.04 US cents, convert it into Australian, and you would end up using that money to repay the Australian loan. So you would end up here with 1.05 Australian dollars, you repay your loan, and you end up using a forward contract. So it has the same type of logic as in our money market hedge, but they're clearly different instruments and flow in slightly different ways. Our next method is risk shifting. So risk shifting involves a situation where you effectively force the other party to bear the risk. It avoids the exposure by invoicing everything in your home currency, i.e. if you're a US firm, you invoice everything in US dollars. In that respect, the other party bears the exchange risk. So it's a zero-sum game, i.e. someone is going to bear the risk, but in this case, it's the counterparty rather than you. Now this can be common in international business transactions. The reason it's common is the contract has to be denominated in someone's currency, i.e. someone is going to bear a risk. And obviously it's desirable to get the other party to bear that risk. Now exactly which party ultimately bears that risk is going to depend a bit on the bargaining power of those parties, i.e. the stronger the party, the less risk it is likely to bear. So in that respect, it's not going to be really a fair situation because the stronger party is always going to be able to avoid that risk rather, and the weaker party would ordinarily bear the risk. So that's effectively what would happen. Now to some extent, the party that has more bargaining power can try to game the system. So if that party has some speculative views on what's going to happen to currencies, it might try to force the denomination in the currency that it is going to benefit from. But nevertheless, the stronger the bargaining power, the more say you're going to have in risk shifting. In terms of exposure netting, it's often commonly used, particularly for multinationals. Basically, one will have offsetting exposures in different currencies. Now, what would happen here is you would have a receipt in one currency and you'd have a liability and try to get those two to match up. And you would typically try to centralize this in a multinational context. You would centralize it because you have a multinational, invariably, one subsidiary might have a receipt in one currency, the other a liability in that currency, and you try to net them together. It to some extent reduces exchange rate risk. Now it typically would not eliminate it. It's going to reduce it by netting off some of that exchange rate risk. And it's based on the idea that a receipt in one currency and a liability in that currency are going to have different exposures, i.e. if the currency appreciates, your receipt might be worth more, but your liability is also going to be more costly. And these are going to offset one another. So for example, you offset a long position in one currency with a short position in that same currency, i.e. if you need to perhaps buy that currency, then you have receipts in that currency and vice versa. If two currencies are positively correlated, you can sometimes, to some extent, imperfectly net. So for example, the US dollar might be positively correlated with some other currencies. So in that case, if you've got an exposure in something correlated with the US dollar, you can kind of net that with a receipt. Now, that to some extent is not going to be perfect, because you typically won't have currencies that are perfectly correlated unless they're pegged. And you can also conversely use currencies that are negatively correlated. In that case, you would have the short positions, i.e. if they're negatively correlated, then you can effectively take the same side of the transaction in both of those currencies because they're going to move in opposite directions. So effectively the idea here is to net your receivables with your payables. And the netting there is going to depend on how correlated those currencies are together. So let's have a look at a really basic example of exposure netting. So suppose we've got Apex Computers. It has the following transaction exposure. You might recall the transaction exposure is exposure due to contracts that have already been entered into, but it can have future cash flow implications. So we have, for example, marketable securities of 2.4 million euros, accounts receivable of 6.2 million Swiss francs, accounts payable of 15.4 million Mexican, and bank loan of 14.8 Swiss francs, and a tax liability of 1.1 million euros. So what you'll notice here is to some extent there's a bit of an offset here. Now, when we net these, we can net them to some extent. Now, the netting is basically going to net our assets with our liabilities. All right, so let's have a look at our euros and just net our euros. So focusing first on our euros, we've got 2.4 million in marketable securities and 1.1 million is the tax liability. So that's the first thing we can see here. So those two are firstly going to net out at about 1.3. But we'll also look at some other factors that might arise here. Now we've got 1.3, so we've got as our euros here. Now we'll look at the US dollar exposure in a second, but that's 1.3 million euros. Now if we're next moving on to Swiss francs, now what we'll see when we next move on to Swiss francs is we've got 6.2 as our accounts receivable, and we've got 14.8 as our bank loan. You net these together and you end up with 8.6 as your net liability in Swiss francs. Then if we move on to Mexican pesos. Now in terms of our pesos here, we've just got 15.4 million. And we've only got 15.4 million as our liability. We don't have any form of offsetting asset at this point. So we have these three heads once we've net them. And then what we can do is we can do our conversion to US dollars at that prevailing rate. So once we've done that conversion, you end up with US dollar amounts that are listed right here. Of 1.9 million conversion of the euros into dollars, 8.5 of the conversion of francs into dollars, and 2.2 of the conversion of pesos into dollars. So you're effectively doing here an offset. Now, to some extent, you can add some complexity to this. The complexity arises where you have correlations between currencies. So say there's a positive correlation between euros and francs, which is probably realistic, and a negative correlation between euros and pesos, just so that we can look at an anecdotal or a hypothetical example rather. So in that case, Apex here is short in francs and long in euros. So you can kind of net these together. Now we're going to assume a perfect correlation, which is not realistic, but let's just assume a perfect correlation. I'm going to focus on the US dollar equivalents here. So then you end up with a net short Swiss franc / euro position. If you do the netting here, i.e. 1.9 minus 8.5 will give you that net short. Now, if we look at the francs and the Mexican pesos, you can offset your 6.5 million short francs with your Mexican peso franc. So you've got 6.6 million minus 2.2. Because you recall those are negatively correlated, so we've got our position here overall of 4.4. So our net short of 4.4. So obviously we've sort of netted some things together and made some assumptions about correlations between currencies. Now, currency risk sharing is a situation where you might try to share risk between maybe some of these countries or perhaps some of these companies. So you develop a customized hedge contract where you're sharing some of the risk. Now, who exactly shares it is going to depend on the nature of that contract. So there's typically some form of price adjustment feature which might change to reflect exchange rate changes. i.e., if you've got this currency risk sharing arrangement, you might feed into your contract a provision whereby the currency or the amount of the particular obligation or receipt will change as the currencies change. i.e., it's not just locked in a currency, but that can change over time. To some extent, it's going to help to lock in at least a band or a range of currencies exposures, i.e., it might enable you to perhaps post some limits on how much you're going to lose. So let's have a look at one example here. Suppose on January 1st, GE is awarded a contract to supply turbine blades to Lufthansa. Now in that case, we're going to be looking at a German company and GE is an American company. On December 31st, GE will receive a payment of 10 million euros for these blades. The current spot rate is $1.5 per euro, and the 1-year forward rate is $1.79 per euro. So our forward rate here is at a discount to our current spot rate. Let's have a look at different ways of hedging this. So let's first focus on forwards and futures. Now for our purposes, they are very similar. Again, to reiterate, the forward contract is over the counter and can be customized. The futures contract is going to be one that is going to be exchange traded and is more standardized. But let's just assume that they're the same general function for the moment. So in that case, GE is going to receive 10 million euros. So you could sell euros short, i.e. you're selling euros using this forward contract. Or phrased differently, you would buy a forward contract in the opposite direction to your cash flow, which would mean you'd be selling euros and buying dollars. So you're going to get a long position in euros in the physical market. So you would sell euros forward for US dollars. So in the case of this 10 million euro receivable, i.e. the payable from Lufthansa, what you would end up doing is you'd sell forward 10 million euros, and according to this forward or futures contract, you would get 14.79 million US dollars, i.e. you would lock in 14.79 million. It's relatively simplistic. The upside is you've locked in the result. The downside is, again, you've locked it in, which means that if the currency would have moved more in your favor, then you could have gotten more money. So if the spot rate were higher, i.e. or like $1.5 per euro, then you'd be able to get more money if you had unhedged. So GE is only ever going to receive 14.79 million US dollars if they were to use a forward or a futures contract. Now we can look at a money market hedge. Now we saw money market hedges earlier on. So you're going to be borrowing and lending in these currencies. So what we'd be doing is we'd borrow the present value of 10 million euros for a year, as we saw earlier on. Then you convert that present value into US dollars. You would then invest those US dollars for 1 year, and you'd use the US dollar receivable to pay off the euro loan, i.e. what you're effectively you'll use your US dollar receivable to effectively as your translation for your euro. What you would effectively do here is you'd get your receivable, you'd pay off your euro loan, and then your implicit exchange rate is how much you get from a US investment divided by your euro receivable. Now, according to risk shifting, you can do this in multiple different ways. You could, for example, contract that the amount of the contract is going to change as currencies change, or you could contract in different ways. So you could, for example, contract that within a certain band, companies bear their own risk, and outside a certain band, they start to share the upside and downside of it. So GE might invoice in US dollars. If GE were to do this, Lufthansa is the one that bears all of the risk. They could alternatively, of course, share some of that risk, but in the risk shifting, GE is just going to invoice in US dollars, and in that case, Lufthansa is going to bear the risk. Lufthansa then could potentially use a forward contract to offset that risk. So Lufthansa in that case would have to buy US dollars forward. So in that case, Lufthansa would lock in the price of 14.79 million. So the main difference here is who has to hedge the risk. In our prior example, GE had to hedge. Right now, Lufthansa has to hedge. Let's have a look at the currency risk-sharing environment. Now, in the currency risk-sharing environment, the parties are effectively sharing the risk of the exchange rate changing. Now, the amount to which they share is obviously what is going to be specified in the contract. But let's have a look at how this could be specified. And say we have this situation again where we've got this receipt of euros or this payment of euros, as the case might be. So in this case, for example, Lufthansa is going to pay for these turbines. I paid the 10 million euros. All right, so what you need in this risk-sharing environment is you start off with a base rate. This base rate is effectively a rate that you pre-specify. So in our case, we're just going to set that as our spot rate. And we're going to look at changes from that spot rate over time. Two other parameters you need are an upper limit and a lower limit. So this is going to give rise to what could be called a neutral zone. Now we'll see what that means in a second. So we've got our upper limit, hypothetically 1.52, and a lower limit, hypothetically of 1.48. Now those will be specified in the contract. They could be effectively any number you specify. Now effectively what happens is in the neutral zone, so between 1.52 and 1.48, you're going to have the neutral rate, or the base rate rather, being your exchange rate. I.e., if the exchange rate is anywhere between 1.48 and 1.52, your exchange rate is deemed to be 1.5. However, if it goes above or below, you're going to start to share that currency change. So let's have a look at how that kind of works. So within the neutral zone, Lufthansa has to pay $15 million. So in this case, GE is forcing Lufthansa to pay 15 million US dollars. Now, what happens outside the neutral zone? So let's have a look at what happens if the currency goes below, i.e. our exchange rate starts to decline. Now in that case, they start to share the decline if it goes below 1.48. So in that case, say it goes below 1.48, hypothetically down to 1.4. Then in that case, they're going to share the difference between 1.48 and 1.4, which is a 0.04 difference when you do the halving of it. Let's have a look at how that works. 1.48 minus 1.4 divided by 2. That's going to equal 0.04. So the way you look at the implicit exchange rate is going to be your base rate less that shared amount. Now the shared amount is 0.04, i.e. the distance from the bottom level divided by 2. So your implicit exchange rate here is 1.46, giving you an amount of 14.6 million US dollars. Now, to be clear here, that isn't a real exchange rate. It's not a market exchange rate. It's a manufactured exchange rate for the purpose of the contract. i.e. you're creating an exchange rate that is going to apply to this transaction when the exchange rate falls down to 1.4. Now, suppose the market exchange rate goes up to 1.6. So how do we do that? Well, if it goes up to 1.6, then what you'll notice is we've now gone from 1.52, which is our upper limit, up to 1.6. So we've again got a difference of 0.08 here. Divide that by 2 and you end up with a 0.04 shared amount because we're sharing that 0.08 move. So you add that to your upper limit. So 1.5 plus 0.04 equals an implicit exchange rate of 1.54. So in that case, Lufthansa is going to pay 15.4 million US dollars. Effectively, what's happening here is the two parties are sharing some of their exposure, i.e. sharing what happens if the exchange rate moves outside a predetermined band that they specify in their contract. Currency collars are going to be very similar in nature. They protect against adverse movements outside an agreed upon range. Now, that risk-sharing environment was somewhat similar in that respect to some extent. So, for example, in our previous example, we had a range. You might be willing to accept variations with the US dollar within that range of $1.5 to $1.55 per euro. Outside that range, the currency collar could provide protection. So in that case, you might use your collar to lock in an exchange rate floor of 1.5 or lock in a ceiling of 1.5. So effectively what it's going to do is it's going to ensure that you're able to lock in an exchange rate band here. Now this could be a cheaper option. The reason it's cheaper is say you went with a straight option, i.e. a straight option, i.e. a put or a call, whichever the case might be. If you do that, then you're going to have to pay the option premium. Whereas with using a collar, you'll oftentimes have an offsetting premium. And oftentimes you'll be buying it in an exchange rate that is less favorable to you than just buying a straight call or a put. So it often ends up being cheaper than just going out and buying a straight currency option, which would be another alternative, of course. Now you could also use cross-hedging. Now with cross-hedging, you might say use correlated currencies. So you use cross-hedging in perhaps available correlated currencies. This would generally be done where a futures or a forwards contract is not available on the currency that you're particularly interested with. In which case, it's effectively like a cross currency. So if you're just looking at trying to get a currency exchange rate in currencies that aren't otherwise traded, this is effectively the same type of idea here. You're effectively hedging by taking on a forward or futures contract in a correlated currency rather. So effectively you have a correlation here that enables you to offset your obligation or your receipt. Effectively here, you're cross-hedging by using futures or forwards contracts in available correlated currencies. I.e., if you use a forward or futures contract in your specific currency, there's perfect correlation. But what we're doing here is a forward or a futures contract in a imperfectly correlated currency, which is going to partially hedge your exchange rate risk. Now we could also hedge with options, of course. Now when we hedge with options, effectively end up with a situation where we've bought the underlying currency and implicitly sold the underlying currency, but we have the right but not the obligation to do so. We've locked in our exchange rate and we can do it at that predetermined exchange time through the expiration date. Now options are useful in a couple of situations. It's useful when there's uncertainty about whether the cash flow will materialize, or there's uncertainty about whether there's going to be an adverse change. So for example, if there's a risk that the contract is going to fall over, then an option is useful. The option is useful because say that contract you have is going to fall over, then you just don't exercise the option. You've lost the premium, but you haven't lost any more money. So in our example, say GE didn't know if Lufthansa would pay for the turbines. In that case, GE might just use an option rather than a forward or a futures contract. Furthermore, if GE wanted to put, say, a floor under the exchange rate, but it wasn't sure that there would actually be an adverse change, then an option could be useful. i.e. if GE thought on the balance of probabilities, the euro would appreciate, and therefore the receipt would be worth more, GE might decide to go with an option just to hedge some of the downside risk. But if it believes the euro might appreciate, then it might try to take advantage of some of that upside. So in that case, you might use an option rather than the forward or a futures contract. So let's have a look at one example here. So say, for example, we've got our same situation here. The current spot rate, for example, is 1.4 in this option example. Now, we've got a few options. We can be unhedged. We can sell 10 million euros forward, for example, at that $1.479 per euro exchange rate. Or alternatively, we could use an option. So we could, for example, buy $100,000 put option, and what we could do is we'd sell 10 million euros on December 1st at the strike price of 1.479. So in that case, we're effectively paying a premium to buy our put option on the euros. So in that case, we've gone out of pocket a certain amount. So in this case, $100,000, but we've been able to take advantage of upside if it materializes. So in our unhedged position, let's have a look at an example. Say the exchange rate falls to $1.43 per euro. In that case, what is our loss? Well, in this situation, our spot rate, I said, was $1.479 per euro. It's gone down to $1.43 per euro. So our loss is 1.43 minus 1.47 multiplied by 10 million equals a loss of 490,000 US dollars. GE could also use a forward contract. Now, say we were to use a forward contract, we'll sell short 10 million euros. So say our forward rate is 1.479, you'd lock in 14.79 million US dollars. Now, that's great if everything goes to plan and you receive your 10 million euros. But say this doesn't occur. GE loses the bid or Lufthansa goes bankrupt and can't pay, whatever the case might be. Say that were to be the case. What we'd need to do is we need to go around and effectively reverse our transaction. So you've sold forward 10 million euros, you're going to need to reverse that. Now, say for example, you find out on April 1st that everything's fallen over. What you do is you take the opposite side of the transaction. Say we get through to April 1st and the forward rate has changed. It's changed from 1.479 and say firstly it's changed to 1.43. Say it changes to 1.43. We've actually made a profit here. The reason we've made a profit is we sold short at 1.479, but the exchange rate's now gone down. So we've sold short at a high rate. So our profit is effectively going to be 1.479 minus 1.43 multiplied by 10 million equals a profit here of 14.9 million. Now think about this intuitively. The intuition here is we would have gotten 14.79 million, say we sold our 10 million euros. But what we would get under the new forward rate is 14.3 million. So our profit on our forward is 49,000. So it's actually beneficial here. But it's harmful if the euro has appreciated, because we're going to need to reverse our transaction. So we'd locked in 14.79, but say it goes up to 1.512. In that case, things have moved against us, and we need to take the opposite side of the transaction. So here what we need to do is we go 1.512 minus 1.479, and that's going to give rise to a loss of 330,000 in total, i.e. quite a big loss in this situation. So what you can see here is forwards and futures contracts can be quite risky if there's some chance that your obligation or your receipt is not actually going to come to fruition. So one needs to bear in mind the cost that can be associated with the forwards or futures contracts. And in this case, under this scenario, that the exchange rate moved against us, we end up losing more money than we would have under the option premium. So let's go back to our put option. So say we paid 100,000 to get our put option on January 1st to sell forward 10 million euros on December 31st. And say our strike price is 1.479. Now say everything goes to plan. What we do is we get our 14.79 million euros from exercising the option. Now, of course, you still need to pay your $100,000 premium. So that's going to reduce how much money you ultimately end up with on net by $100,000. But nevertheless, you exercise the option and you receive your money. Now, say GE loses the bid, i.e. they don't get the turbine bid or it just falls over or whatever the case might be. GE won't have any reason to exercise the option. They potentially are going to lose the premium that they've paid. Now, they might be able to turn around and sell the options in the market, which might enable them to recoup some of that premium. But they're certainly going to lose the 100,000 upfront, and they'll probably make at least a bit of a loss, because it's possible that the time value of money will have reduced over time. So say you went around and sold your options in the market, you might not get back your full $100,000. Let's have a look at hedging with options in another situation. So suppose we've got DKNY, the apparel company. They owe 7 million pesos in 30 days' time. And this is for a recent shipment of textiles from Mexico. DKNY wants to hedge the company's peso exposure. And they can hedge this in various ways: options, money market hedges, etc., etc. So suppose our spot rate at the moment is 13 pesos per dollar. The forward rate for 30 days is 13.1 pesos per dollar. The 30-day put option trades at a 1% premium, where it has a strike price of 12.9 pesos per dollar, and the put option with a strike price of 13.1 has a 3% premium. What this tells you is basically if you're going to want to sell your pesos at a higher price, then you're going to have to pay more. That's basically what it's saying. Now what we also have is the US interest rate is 7.5% annualized, and the peso interest rate is 15% annualized. So let's have a look at some hedging options that might arise in this situation. Alright, so suppose we've got a forward contract. What we could just do here is we could buy pesos at 13.1 pesos per dollar. Easy. So basically what you've done here is you've bought pesos using a forward contract. Super easy here. You also have a money market hedge, where what you effectively do is you borrow the dollar equivalent of the present value of $7 million peso payable. i.e. you have to pay 7 million pesos, so you're going to make the dollar equivalents here. And we'll look at how that works in a second. Now with options, what you could do is you could buy a peso call option. So what you would do here is you'd be buying calls on pesos because that's what you would need to be purchasing here. So let's have a look at all of these different scenarios and how they work. So forward contract is super easy. You buy a forward contract and you're buying pesos forward. So for example, you buy pesos forward at the forward rate of 13.1 pesos per dollar. So therefore you lock in and 7 million pesos you're payable, divide through by 13.1 equals 534,000 US dollars. The reason we divide through by 13.1 is because our exchange rate is expressed as pesos per dollar. So if you want to convert the pesos into dollars, you need to take your peso amount divided by the exchange rate. So hence 7 million divided by 13.1, which is going to give you $534,000. So that's our first scenario using forwards. It's relatively straightforward. Let's look at our next scenario using a money market hedge. Now what you'll again recall here is we have to pay 7 million pesos. So let's have a look at how we might do this. So we're going to have to pay 7 million pesos. So what we effectively do is we lend 7 million pesos, lend the present value of 7 million pesos, so we get it back in that month's time. So let's have a look at how all of this works. Because for us to lend 7 million pesos, we're going to need to convert our US dollars right now into pesos, lend in pesos, and to get the US dollars right now, we need to borrow US dollars. So let's see how all of this works. Alright, so firstly, we borrow the present value of 7 million pesos in US dollars. So what you do is you take 7 million pesos, convert it at the prevailing spot rate. Our prevailing spot rate at the moment, from memory, was 13.0 rather. So what you do here is the present value of 7 million pesos. To do that, you take 7 million divided by the exchange rate, divided by the interest rate for 1 month. So interest rate is 15%. So the monthly interest rate is 15% divided by 12. That's going to give us our present value. So our present value is 6.913 million pesos. Convert that into US dollars. Convert it at the spot rate. The spot rate is 13.0. So you divide through by 13, and that's going to give you 531,844 US dollars. What you then do is you borrow that amount of US dollars, and you lend the requisite amount in pesos. So you have lent your 6.913 million pesos for 30 days. Now, that's going to enable you to receive 7 million pesos in 30 days' time. What you also do, because you've borrowed your US dollars, you've borrowed your 531,000 US dollars, you're going to need to repay that in a month's time. So you need to repay that with interest. So we have 531,000 multiplied by the US interest per month. The US interest rate was 7.5%. Divide 0.075 by 12 to get the monthly interest rate, and you're going to have to repay 535,000 US dollars in a month's time. So effectively what we've done here, to simplify what's happened. To simplify this, we have 7 million pesos we need to pay in a month's time. Now, in order for us to get 7 million pesos in a month's time, we lend the present value of that amount for 1 month. Now, in order to get the present value of that amount, we need to borrow. We borrow US dollars and convert it to pesos at the prevailing spot rate. Now, because we've borrowed US dollars, we need to repay those US dollars in a month's time. So we need to repay that in 30 days. So the amount we needed to repay was 535,000. Now, what this does is it implies an exchange rate. It implies an exchange rate of 13.081. That 13.081 implicit exchange rate is effectively 7 million pesos divided by 535,138 US dollars. And that's going to give us our implicit exchange rate of 13.081. Again here, this is an implied exchange rate that we have manufactured by the use of money market instruments, i.e. it's going to be the $7 million that we already had to pay divided by the amount in US dollars we locked in, and that's going to enable us to calculate our exchange rate in pesos per dollar as 7 million divided by $535,138. We can also use options. Here we can buy a peso call option. The reason we're getting a peso call option is we need pesos in 30 days' time, so we're going to buy a call on pesos. Now, we don't have a specific quote for the peso call option, but what we do have is we have puts, and we have puts on dollars. So when we have puts on dollars, a put on dollars is effectively a call on pesos, because say, for example, you have a put on dollars, you're selling the dollars, which implicitly means you're buying pesos. Now what we've got here is two options. We've got, and these are both puts on dollars. We've got 13.1 pesos per dollar and 12.9 pesos per dollar. Now, one could use either of these two, but ultimately which one you want to use depends on how much you want to pay and how much you fear the exchange rate is going to move in a particular direction. So in either case, you can use either of these, but they're effectively going to translate into calls on pesos. Alright, so let's have a look at how this works. These are going to give us the right to sell US dollars for Mexican pesos at, say, 12.9 pesos per dollar in our first option. Now, the contract size in dollars is going to have to be 7 million pesos. Divide that through by the exchange rate of 12.9 equals $542,636. To get our premium, it's then going to be 1% of that, which is going to be 5,385. So the total cost when exercised is effectively going to be our 542,000 plus our premium, and that's going to give us a total cost of our option. Our premium plus the amount we have to pay when we exercise the option is the total cost of this transaction. So we've got our three different situations and our three different total costs. Our forward contract at a total cost of 534,000, our money market hedge a total cost of 535,000, and the put option a total cost of $548,000. Now the US put option is more expensive, but is also the most flexible, and if our contract falls over, or for whatever reason we don't have to do this payable, the put option enables us to just exit the whole situation, only having paid our premium. The others in that case would ultimately end up being more costly. Alright, so if we think about this, forwards and futures versus options, what are the benefits and otherwise of these? Well, the forwards and futures, if we have a known amount, then, and that known amount is effectively going to always occur with certainty, i.e. there's not really risk of it occurring. In that case, we could, say we have an outflow, we could buy that foreign currency forward. Say we have a foreign currency inflow, we'd sell that foreign currency forward. Now, say for example we have an unknown amount of that foreign currency, and we don't really know whether it's actually going to occur. So for example, there's a risk the contract might fall over, or the other party goes bankrupt, or whatever the case might be. In that case, you might use an option. And you'd use an option regardless of whether it's an inflow or an outflow, but obviously use a call or a put as the case might be. Now, you might use a mix of these depending on what you want to do. So say you have known and unknown foreign currency amounts. In that case, you might use forwards and futures for the portion that you know is going to occur, and options for the portion that you are unsure might occur. So in that case, you'd be mixing and matching to reflect the nature of the amounts that are going to arise in the future. Now, in terms of our economic or operating exposure is the extent to which future cash flows might change with exchange rates changing, i.e. it's a situation that might arise from future revenues or something similar. So, for example, at the beginning of 2002, the US-Euro exchange rate was about 86 US cents per euro. By mid-2003, the euro had appreciated to $1.15 per euro. So European manufacturers, say they had to buy in US inputs. Those European manufacturers would have had cheaper supplies, but of course the exports are going to decline because the euro is now just much more expensive. So in that case, their profits could also be hit by virtue of these exchange rates changing. And you can see how this would affect a purely domestic operator, because even a purely domestic operator is going to see their revenues potentially change as the exchange rate changes, and therefore their goods become more expensive or become cheaper, as the case might be. Now, in terms of this economic exposure and foreign exchange risk, we've also got to consider nominal and real exchange rate changes. Now, this to some extent could be quite familiar to many people. Now, the real exchange rate was effectively our exchange rate that we have deflated for the impact of inflation. So to get our real exchange rate at time t, we take our nominal exchange rate at time t. Now suppose the exchange rate is expressed as home currency over foreign currency. Then we multiply through by 1 plus the foreign inflation over 1 plus the home inflation, where the exchange rate is going to be expressed as home currency over foreign currency. So one has to make sure that you get the numerator and the denominator correct here. Now, the change in the nominal and the real exchange rate is obviously important because it can affect how much in real terms you've had an actual exposure arising here. So as just one really basic example, say the yen per US exchange rate is 79.75 yen per dollars in 1995 and 81.36 yen per dollars in 2010. If the US inflation over that period is 69.5% and the yen inflation was 8.5%, we can look at, well, what's that real exchange rate? Now, to get our real exchange rate, what we do is we take our 81.36. Then what we do is we need to multiply through by our relevant inflations. Now, you'll notice here the exchange rate is in yen per dollars. So what we have here is we need to multiply through by the US inflation divided through by the Japanese yen inflation, i.e. 1.695 divided by 1.085. US inflation over yen inflation. So our real exchange rate is 127.1. So what we've seen here is our dollar in real terms has appreciated over this time period. Put differently, the US dollar in nominal terms has not depreciated that much. Therefore, notwithstanding the inflation, the US has actually gone up in value in real terms, even after you have deflated for the impact of inflation. So what has been the change in real terms? Say we're looking at the change in US in real terms. we take our real US dollar amount, i.e. our 127 that we just worked out, subtract off the starting amount, so 79.75, an exchange rate at the very beginning. And to get it in percentage terms, divide through by the exchange rate at the beginning equals a change in real terms of 59%. If we wanted to get the real change in the yen, we need to take the reciprocals, so it's 1 over 127 minus 1 over 79.75, all divided by 1 over 79.75, i.e. the exchange rate at the end minus the exchange rate at the beginning, divided through by the exchange rate at the beginning, equals a decline of 37%. Notably here, the appreciation in the US is not the same amount as the depreciation in the yen. So they're not simply mirror images, one has to do separate calculations for each. And you can see how those calculations manifest when we look at the equations here. Now, real exchange rate depreciations can sometimes be harmful. Now, they can be harmful depending on your perspective. They make exports and import competing goods more competitive. However, a real exchange rate appreciation makes imports perhaps more competitive. So really, depending on your perspective, depends on whether the real exchange rate appreciation or depreciation is better for you. So effectively, these are going to result in price changes regardless of whichever the situation is. And they are going to have economic effects, clearly. So there can be long-run exposures for corporations resulting from these price changes. Now, real exchange rates can have some side implications for transaction exposure. Now, clearly, real exchange rates aren't something you observe in the market, but they are things that companies might want to be cognizant of. So let's have a think about how that might occur. So suppose an Australian company imports Halloween candy from the US. It has a US $100 million payable in October 2020. The current exchange rate is 0.71 US per Australian, albeit that's optimistic given the current state of the Australian dollar. The inflation rate in Australia is 3.5%. The inflation rate in the US is 2.5%. All right, so let's have a look at real changes here. So suppose the exchange rate on October 2020 is 80 US cents per Australian dollar. How has the payable changed in real terms? Well, let's have a think about this. Let's get our real exchange rate first. So our real exchange rate is the 80 cents multiplied by our inflation differential. So in this case, it's going to be 1 plus the Australian inflation over 1 plus the US inflation, i.e. 1.035 over 1.02. So our real exchange rate here is 81.176 cents, i.e. 0.8176 US per Australian. Now, in October 2020, the payable is then, in real terms, $100 million, divided through by our exchange rate of 0.8116, and that's going to give us, in this case, 123.19 million Australian in real terms. Now, that's effectively in real terms what it's going to be. Now, say we look at today's exchange rate. On today's exchange rate, the value of the payable would be 100 million divided by 0.71, which is going to give us 140 million. So in real terms, we've actually seen a decrease. Now, in nominal terms, using the nominal exchange rate of 80 US cents per Australian, it would be 125 million Australian dollars in nominal terms. So what you can see here is the actual cost in real terms has decreased, but the nominal value has actually increased. So you can kind of see what's happened here. Now, there are some economic consequences of exchange rate changes. Now, economic consequences are going to depend on various things, such as the price elasticity of demand, which is going to tell us how sensitive is demand to changes in the exchange rate. The degree of differentiation between goods, which is effectively how different are your domestic goods from the foreign goods that might be imported, which is going to have implications for whether people simply shift from one good to another as exchange rates change. And also the ability to shift production across countries, which might enable one to have some degree of pricing flexibility if you can shift across countries and therefore minimize the impact of exchange rate changes on your balance sheet. So let's have a look at how we might apply some of these concepts into various different exercises and situations, and I'll have a look at an exam question that I've seen that will give us some insight into how to actually apply these in a context. Okay, so suppose we have Megatronics, and it owes a supplier 205 million Taiwanese dollars, a supplier based in Taiwan, in 3 months. The company wishes to hedge its payable. The current spot rate is 1 Taiwanese dollar is equal to 0.03987 US dollars, i.e. we've got 1 Taiwanese dollar is going to give us 3.987 US cents. And the 3-month forward rate is 1 Taiwanese dollar is equal to 4.0501 US cents. Magnetronics can also borrow/lend in the United States at an annualized interest rate of 12% and in Taiwanese dollars at an annualized interest rate of 8%. Let's have a look at how we might use a money market hedge to deal with this situation. Now, notably here, they have to pay 205 million Taiwanese dollars. Now, since we know they have to pay that, we know that what we're going to want to do is we're going to want to lend in Taiwanese dollars so we can receive back 205 million in the time period, in 3 months' time. Now, in order for us to lend in Taiwanese dollars, we're going to need to borrow in United States dollars. So let's see how this might work. All right, so we'll use our money market hedge or a forward. Now, suppose we've got a forward contract. The forward contract could hypothetically just lock in 205 million Taiwanese dollars multiplied by the forward amount of 4.0501, and what we'll end up with is 8.304 million US dollars. A money market hedge is more complicated. So what we first would need to do is we have 205 million Taiwanese dollars that we need to get. So what we need to do is we need to invest the present value of that. So to invest the present value of that, we get our $205 million and discount it back. Now you'll notice here the annualized interest rate is 8%, and this is for 3 months. So you take 8% multiplied by a quarter, which is 0.02. And therefore what we're going to do is 205 divided by 1.02 to give us 200 million Taiwanese dollars. Then we convert that into United States dollars because that's going to tell us how much we need to borrow in the US. So we convert it through at the current spot rate of 0.03987. That's going to give us 8.03013 million US dollars. Then what we need to do is we need to borrow this. Now when we're borrowing our 8.013 million US dollars, we'll need to pay interest on our repayment. Now the prevailing interest rate in the United States is 12%, and we're borrowing for 3 months, so a quarter of a year. So what we do is we take our 12% divided through by 4, which is going to give us the 3 months interest. And what we then do is we multiply it by our US dollar amount. So we take our 8.013, multiply it by 1.04, and that's going to give us, 1.03, sorry, and that's going to give us 8.253 million US dollars. As a result, we've implicitly locked in an exchange rate, i.e. the 8.253 divided by 205 million Taiwanese dollars is our implicit exchange rate here. So our money market hedge is one way of going about this. So if we have a look at the costs here, the money market hedge cost us 8.253 million, the forward contract cost us 8.304 million, so the money market hedge in this case is the cheaper of our 2 options. Let's have a look at an example here that's come from a past exam. So suppose you're an Australian firm exporting to the UK, and you have an account receivable of £500,000 in 6 months' time. If you expect the pound to sharply appreciate over the next 6 months, what is your best hedging strategy? So here we're expecting the pound to appreciate, and we're expecting to receive pounds. So what we've got here is we're expecting our pounds to be worth more in the future. So there are a few things we want to knock out here. So say we're going to get pounds, well, we're certainly not going to buy a call on pounds because we're receiving pounds. We're certainly not going to get a forward to sell pounds, to buy pounds rather, because that's what we're going to get. So we're left with 3 other options: no hedging, buying a put, or selling pounds using the forward. Now, each of these has advantages and disadvantages. The no hedging is risky, but if we really expect the pound to sharply appreciate, then that's probably our best strategy. Buying the pound put can be expensive, and it might be worthwhile maybe to get a put that's significantly out of the money, but certainly if we're getting a put that's somewhat close to the money, that might be somewhat expensive. So we might really not want to get the put, because that put could be super expensive for us, so we might not want to go with that option. Now if we get a forward to sell the pound, then we're going to be foregoing the upside. So in this case, we might be better off with no hedging. So our answer here is often no hedging because that might result in the best option if the pound ultimately sharply appreciates. Let's have a look at another exam question. So suppose American Airlines is deciding how much to hedge and deciding about hedging, and is trying to hedge 80 million francs here in ticket sales receivable in 240 days. Suppose it faces the following exchange rate and interest rates. The spot rate is 97.2 US cents per franc. The forward rate is 99.85 US cents per franc. We've got two options, and both listed here are put options on francs, which are implicitly calls on dollars, with 1 and 2% premiums respectively. And then we've got money market hedges, or money market hedge parameters. And we have interest rates of 5.9% in francs and 10.1% in dollars. All right, so let's have a look at what might arise here. Which hedging strategy does not help American Airlines hedge the transaction risk? Let's have a look at which ones wouldn't help. Now, this is relatively straightforward because we don't really need to calculate things. We just need to look at what wouldn't help. So let's have a look through this and see why it's the case that option E is wrong, is the answer here, and why it wouldn't help. All right, so the first one, enter into a currency risk-sharing arrangement. Well, that could help you hedge. Now, it's not going to perfectly hedge your exposure, but it's certainly going to reduce it. So a currency risk-sharing arrangement can be a way of helping. Now, in the next one, invoicing ticket sales in US dollars. That's certainly going to help American Airlines because you're going to be able to shift your exposure into US dollars only, which means you don't have to hedge now. However, the other parties might have to hedge, but here just having US dollars is going to eliminate your exposure. Next one, you can enter into a forward contract to sell francs. That can reduce and potentially eliminate your exposure because you expect to receive francs, so you've got a forward contract to eliminate it. Or you could buy a franc put option, because here you'd be buying an option to sell francs. And because you're going to be getting francs in the real market, getting the put option is the best way here if you wanted to use an option. And you can see buying the call option is the one that wouldn't work. The reason buying a call option wouldn't work is a call option on francs is the right to buy francs. And because you're going to be receiving francs, you wouldn't want to use a call option. So as a result, that's the one that won't help you hedge your exposure here. Hence why you wouldn't be using a call option. Okay, so let's wrap up what we've looked at. So we've looked at several things, including the type of exposure that might arise, i.e. operating exposure, transaction exposure, translation exposure, and the ways one might go about hedging these and what these exposures entail. So we've looked at ways of hedging it, so things like forwards and futures, options, money market hedges, or the decision strategically to not hedge. We've looked specifically at money market hedges, and it's important to know how you would use a money market hedge to hedge an exposure and what costs might entail from it, and the way you would go about doing it. We've also looked at implicit exchange rates that can arise from a money market hedge, and how you would calculate the exchange rate that a money market hedge implies. Now finally, we've looked at gains and losses on various different types of hedging, when you would want to use a forward or a futures contract versus an option, when you would gain or lose from them, and what would happen when a contract you expect to arise happens to fall over, and when you get gains and losses if exchange rates move over time. So that's effectively what we've looked at. I hope this has been useful for you. We'll build on this in other subjects and also build on this in other videos. And this video itself has built on various other concepts that we've already addressed. So thanks so much for listening in. I do hope the video has been interesting to you, and we're going to cover future and other interesting concepts in other videos.